All right, today we're going to demystify one of the most interesting tools out there for investors, the put option. And we're going to look at it strictly from the buyer's point of view. How does it work? When does it make sense? And what are the real risks involved? But first, you know the drill. We have to get the important disclaimer out of the way. Please remember that this is all for educational purposes. Options trading is a whole different ballgame. It comes with significant risks, and it's absolutely crucial that you understand those risks inside and out before ever making a trade. Okay, let's start with a kind of mind-bending question. What if you could sell a stock for more than it's actually worth on the market? Imagine a stock is trading at, say, 45 rupees, but you have the power to sell it for 50. Sounds impossible, right? Well, that seemingly magical ability is exactly what a put option gives you. Now, this isn't magic, of course. It's a financial contract. This special power, this right to sell at a price you choose, is all made possible by something called a put option. So let's break down what that actually is. So a put option is basically a contract that gives you a choice. When you buy one, you are buying the right, but, and this is the most important part, not the obligation, to sell a stock at a price you've already agreed on. We call that the strike price. And this right isn't forever. It's only good until a specific expiration date. All right, that's the theory. But theory can be a bit dry, right? The best way to really get this is to see it in action with a real-world example. So we're going to walk through a hypothetical trade on a put option for Reliance Industries. So here are the nuts and bolts of our contract. The stock, of course, is Reliance. We're buying the right to sell it at a strike price of 2,560 rupees. Now, the cost for that right, which is called the premium, is 72.60 rupees per share. And because options trade in batches or lots, one contract actually controls 250 shares. So what's our total upfront cost to get into this trade? Well, it's pretty simple. We just multiply the lot size, 250 shares, by that premium of $72.60. And that gives us a total cash layout of 18,150 rupees. Now, this number is super important because it represents the absolute rock-solid maximum amount of money we can possibly lose. Okay, so we've bought our contract. Now let's fast forward to its expiration date, the last Thursday of October. By that point, the stock price of Reliance can really only do one of three things. It can fall, it can rise, or it can stay pretty much where it is. Let's walk through exactly what each of these scenarios means for our money. Let's start with the one we're rooting for as the put option buyer. We bought this option because we had a hunch the price of Reliance might fall. So let's say our hunch was right, and the stock drops all the way down to 2,400 rupees by the time our option expires. This is where our special right becomes incredibly valuable. We get to sell our shares at 2,560, even though anyone else has to sell them at the market price of 2,400. That's an instant gross profit of 160 rupees per share. Now we have to subtract the cost of the option, that 72.60 premium we paid. That leaves us with a net profit of about 87.50 per share. Multiply that by our 250 shares, and we walk away with a total net profit of 21,875 rupees. Not bad. But what happens if we're wrong? What if Reliance stock actually goes up to 2,800? Well, think about it. It would be completely crazy to use our right to sell at 2,560 when we could just sell on the open market for 2,800. So we do nothing. We just let the option expire worthless. The exact same logic applies if the stock price doesn't move at all. In both of those cases, our right has no value, so we just lose the premium we paid for it. Our loss is capped at that initial 18,150 rupees. Okay, let's zoom out for a second and look at the bigger picture. Because for every single buyer of an option, there has to be a seller on the other side of that trade. And their perspectives, their hopes for this trade are polar opposites. So for us, the buyer, the payoff structure is pretty fantastic. Our risk, our maximum loss, is strictly limited to that premium we paid up front. That's it. But our potential profit, well, that's substantial. The further the stock falls, the more money we make. This idea of limited risk but big reward potential is often called an asymmetric payoff. And this is how the two sides of the trade really stack up. We, the buyer, are betting on the stock to fall. The seller is betting on the exact opposite. Our maximum loss, that premium we paid, is their maximum profit. And our huge potential profit, well, that's their huge potential loss. It's a perfect mirror image. One person's gain is the other's loss. So we've gone from the basic definition all the way through a full trade scenario. What are the most important things you need to remember from all this? Let's boil it down. Okay, first and foremost, buying a put gives you the right to sell. Second, you only make money if the stock price drops, and it has to drop enough to cover the premium you paid just to get in the game. Third, and this is so important, if you're wrong and the stock goes up or sideways, your loss is always capped at the premium. And finally, remember, it's a zero-sum game. The buyer and seller are on opposite ends of the seesaw.
So I'll leave you with a little challenge to test your understanding. Based on our example, with a strike price of 2,560 rupees and a premium of about 72 rupees, at what exact stock price do we break even? Where does the stock need to land for our profit to be exactly zero? Give it some thought. It's a great way to make sure this all really clicked.